Hello, everyone. I want to welcome you to part one of our two-part webinar series on rethinking the impact of RECs. This is new insights from project developers. My name is Todd Jones. I am the head of policy at Center for Resource Solutions. I am delighted to be moderating today's discussion. For those of you who may be less familiar with CRS, we're a nonprofit organization that creates policy and market solutions to advance sustainable energy. Our work spans certification, policy and market development, and education. We run the Greenie certification programs, including Greenie Energy, the leading independent third-party certification program for voluntary renewable energy in North America. We engage with regulators and policymakers on renewable energy and greenhouse gas policy design. And through initiatives like the Clean Energy Accounting Project and the Clean Energy Tracking Collaborative, we work to address complex questions around clean energy accounting and tracking that can create barriers to investment and market participation. We also convene the Renewable Energy Markets Conference series and support research and education to strengthen voluntary markets. And all of that work sits at the intersection of markets, policy, credibility, and impact, which sort of brings us directly to today's webinar. This webinar series is about RECs, Renewable Energy Certificates, which for those of you new to RECs are first and foremost an accounting and verification instrument used to allocate specified renewable generation to specific customer load on a shared grid. So RECs are needed to verify all delivery and use of renewable electricity on the grid, regardless of how it's purchased. But today, and in part two next week, we'll be exploring the effectiveness of voluntary RECs as an incentive for or a driver of renewable energy in a variety of different transaction types or purchasing options, and therefore the impact of voluntary demand for RECs or renewable energy. There's been an active debate in academic and policy circles for years, and an increasingly active debate recently, I think, about whether voluntary renewable energy certificates, RECs, meaningfully drive new renewable energy development. And some recent research suggests that certain types of RECs, particularly those with low prices or from existing facilities or sold unbundled from power, may not materially influence renewable energy project finance or development. In fact, the research supporting this conclusion has been described in various contexts as sort of a mountain of evidence or overwhelming evidence. And this viewpoint has become so prevalent that it's often treated as sort of settled, repeated in conversation and embedded in new analyses almost as a starting assumption. Everybody knows that voluntary RECs simply don't have a meaningful impact. And at the same time, voluntary demand continues to grow. Corporate buyers continue to sign long-term contracts. Developers continue to cite, REC revenue as part of the financing stack that enables projects to move forward. So we're kind of left with an important question, why this dichotomy? Are we missing something in how we evaluate REC impact? So today's conversation is grounded in two new companion papers by Dr. Eric O'Shaughnessy. In these papers, Eric draws on interviews with renewable energy developers, investors, other market participants to examine the gap between academic narratives and research and real-world developer experience. And in particular, he explores how traditional financial modeling approach used in research may not capture the nuanced and sometimes indirect ways that RECs influence investment and development decisions. So Eric is an independent researcher with and a longtime analyst of voluntary renewable energy markets. He's worked for many years with the Lawrence Berkeley National Lab, with the former National Renewable Energy Lab, the National Lab of the Rockies now, Environmental Protection Agency, other agencies. And his research for these two papers was supported by Center for Resource Solutions. We're really pleased to have him with us today. We're also thrilled to be joined by Tom Stars, who will be providing a practitioner perspective. Tom's Vice President of Government Affairs at EDP Renewables North America, one of the largest renewable energy developers and operators in the United States. But Tom has decades of experience in renewable energy development and policy and market design, and he has seen REC markets evolve from their early days to today's sophisticated voluntary procurement landscape, and he'll be able to help ground this discussion in the history of those markets and the realities of project development and finance. So the way we'll structure today's conversation is loosely. So I want Eric to walk us through his work and core findings, how he approached the question, what developers told him, what those insights, where those insights, I guess, challenge prevailing academic claims. And then I want to hear Tom's perspective on how RECs actually show up in developer decisions. How do, different contract structures matter, and how these academic critiques could compare to his experience in the market. So I've prepared questions for them, but I want this to be sort of a conversation with both of them, and I want us to be able to go where the conversation leads us. So I'll go back and forth, and we'll see what happens. Then we'll open it up to your questions. So please enter your questions for Eric and Tom into the Q&A box at the on your screen, and then we will get to those at the end. And if we don't get to your question, we will follow up with email, will via email with a response. And then finally, the webinar is being recorded, and we will email you all with a link to the video afterward. So that's it. I think we're ready to go. Let's go. So Eric, before we dive in, could you just sort of briefly describe the academic narrative related to the impact of voluntary RECs on renewable energy deployment, and tell us sort of how you came to, or sort of what drew you to focus on this question?
Sure. All right. Well, thanks for having me. And webinars can be tough for researchers because we have to go through really summarized versions of complicated ideas. So just know there's an iceberg of research and structured arguments behind these ideas. The academic narrative around RECs is largely that the impacts should be judged based on the impacts or the effects on specific new projects. So there's this idea that you level the impact on a project relative to what would have happened without the REC. That's the dominant view. And that position might make sense for the top 1% of buyers who are able to have a meaningful, tangible, unilateral effect on new projects. But the narrative that emerged from that work is if you don't clear that bar, you've essentially done nothing. And that may sound simplified, but there are plenty of examples I could point us all to where that is the conclusion that's drawn. It's binary. You either do bring a new project online unilaterally, or you essentially do nothing. And I was drawn to that because it just never felt right to me. It's a question of scale, and a maybe useful analogy is it wouldn't make sense for a big corporation to report the fact that one of its employees recycles at home. For all intents and purposes, that action does not matter at the level of the corporation, but it matters relative to the capabilities of that individual household. And there's something similar in this space where there's 99%, the long tail of voluntary buyers that rely on procurement practices like RECs, and those do have meaningful impacts relative to the capabilities of those buyers. And that's the narrative I've been trying to produce and counter into this space. And lately, I've been working with developers because I think they are the most authoritative source, and we should be listening to them if they are telling us that RECs matter, which is exactly why I'm excited to be on this panel with Tom.
Great. Thanks. Yeah. And so Tom, you've spent decades in renewable energy development and policy, and you're now at EDP Renewables North America. Could you, I guess, briefly share your background and how RECs have factored into your work, I guess, over the years as a bit of an introduction?
Sure. Yeah. Thanks, Todd. And Eric, great to see you again. So I'm one of those lucky people who found my passion early. I got interested in renewable energy when I was in college. I'm 64 years old now, so that was quite some time ago. We're talking 40, 45 years ago. And not too long after, I my first real exposure to the rec markets came when I was first a consultant and then an executive at an NGO that some of you may have heard of called the Bonneville Environmental Foundation. And uh, and one of the ways that BEF generated revenues to support its nonprofit mission was through the sale of RECs. It was an early entrant, really, in the retail RECs market as an NGO. Um, and as a because it was a mission related business, we could actually generate what in a conventional company would be profit. In an NGO, of course, it's not profits that get distributed to shareholders, but net income that we use to support the rest of our mission, which was supporting renewable energy and also because it's in the Pacific Northwest, a lot of measures to improve fisheries and fishery habitat in the Pacific Northwest. So that's how I first got involved. I did some early work and actually establishing a legal definition for RECs, and worked at the time very closely with CRS in the work that it did in establishing the Green E program and in working actively with CRS to make Green E sort of a gold standard of so to speak in REC certification. So we were very focused on sort of taking the high road with respect to the quality of RECs, including voluntary RECs. And so I spent 4 years at BEF. Since then, I've continued to have a long and winding career in the clean energy sector writ large. And as Todd alluded to, most of the last 20 years have been sort of within the renewable energy industry. So I'm just about at the 6 year mark at EDP Renewables, and as Todd noted, EDP Renewables is a very large um, developer, builder, owner, and operator of renewable energy projects, exclusively renewable energy projects and storage, and in that capacity is very actively engaged in rec markets. And yeah, I'll leave it at that for now because I think we'll dive deeper into what exactly that means in the context of EDP and its business.
Yeah, let's do that. So I want to sort of start off with each of you. Let's just get to the key takeaways first, I guess, on this main question of whether voluntary RECs materially affect renewable energy deployment in the U.S. So, Eric, what have you found?
Sure. So, I guess like why are we even asking that question? Todd mentioned there's been a pretty concerted effort to research Rex that has created that impression that that question needs to be asked. And when I've looked into that, what I've kind of found is this game of telephone. There's a very common thing that happens. You see someone says, Rex do nothing. Rex do not support new project development. And they cite some study that cites some study that cites some study. Um, Possibly no one but myself goes back through that chain and reads all those studies and all of the nuances and the conditions and the assumptions in each one. And if you do that, you realize this is a lot squishier than you might be otherwise led to believe. Academic research is really well structured. The papers at the base of this are conditional and nuanced and come to relatively complex conclusions. They don't support the types of categorical claims that Rex achieve nothing. And when I've gone out to speak to developers, investors, I have never heard that sort of binary view of this action matters and this one does not. Oftentimes I've gotten confused faces. What are you even saying? I'll say, well, there's this study that says this. And developers just don't see that in the real world. Recs are a revenue stream. They are real dollars, just like any other revenue stream. There are nuances to that in terms of when that money comes, revenue certainty. There's lots of details, like I said, below the iceberg. But at the end of the day, RECs are a revenue stream. Developers are for-profit companies that seek more revenue streams. and additional revenue streams will result in additional development. And I guess just to lay out right now, that does not mean we're mapping RECs to new projects on a one-to-one basis, nor are we saying that RECs are saving the world. But it is to say that RECs do have a meaningful role to play in development, and by extension, so do REC buyers.
Okay, so that's how I think I want to get into sort of what the methodologies or sort of general approaches that were sort of taken by those foundational, rec impact studies were, and then sort of how that's different from how you approach the question or how you compare those studies a little bit more. But Tom, I guess again, thinking about this sort of top line takeaways here from the developer's side, you know, are RECs a material element in renewable energy project development or the decision to move forward with a project? How do RECs factor into that decision? And are there any examples that you can provide?
Mhm, mhm. Yeah, I mean, I think Eric kind of made the key point for me, but I'm happy to elaborate. I think there is a lot of complexity here, and there are, lots of questions that I've been a part of over the years about emissions reductions and additionality and so on and so forth. But I think Eric made a key point. RECs have value. And as a seller of renewable energy, we long ago sort of created a framework where we recognized that a megawatt hour from a renewable energy project is different and, in terms of value, better, all other things being equal, than a megawatt hour from a traditional, say, fossil fuel generating facility. Why? Because there's a megawatt hour of energy that serves the same value as the megawatt hour from some other facility, non renewable energy facility. And then there's a value associated with the fact that it's a green megawatt hour. And that's what the REC represents. So as long as there is a world in which we value the provision of energy from cleaner sources, then there can and should be value, and that value can and should be recognized in a monetary sense from the sale of green energy. And the fact that you basically have the ability to split up the energy and sell it here and the REC and potentially sell it there doesn't diminish the fact that those two things are sort of co-produced in effect, and that they each have some independent value. So that's kind of the way that I think of it from a framing perspective. But to get right down to the point, I mean, it's a significant part of our business within EDP Renewables to produce those RECs. That's fundamentally our job, along with the producing the energy and capturing the value associated with those RECs, because that revenue is what helps us helps us be a profitable business as opposed to an unprofitable business, and generate a rate of return that enables us to continue prospering and continuing to grow and continuing to develop what's roughly 1,000 megawatts a year worth of clean energy facilities.
Okay. I think something else that we hear, is, that not all RECs are created equal, right? And so it may be slightly less categorical, but still categorical. You hear things like, well, where the REC prices are too low
Mm-hmm.
or unbundled RECs specifically don't matter. So one of the recurring, let's dig down a little bit deeper into different types of RECs and procurement. So one of the recurring critiques in the literature is that, REC prices are simply too low to influence investment decisions. So, Eric, how do the people that you spoke with respond to that idea? Does REC impact, correlate to REC prices, and is there a price threshold below which RECs don't matter?
Yeah. We could have an entire webinar on just this question. There's so much about prices and the idea of low REC prices. In my experience, when I pose that to developers, again, I get occasionally somewhat of a blank stare. Like, what do you mean? How would that happen? No, what is such thing as a revenue that does not matter to me? It's a notoriously low margin industry. We are always told every dollar counts, and rec prices are usually in the range of multiple dollars. But just to get into this idea of the low rec price, again, it's so complicated. Uh, Prior research has demonstrated, and I'll totally concede this, that there are conditions in which rec prices can be quote unquote too low. The idea here is that RECs are, and Tom kind of mentioned this, RECs are kind of a byproduct. They come along with another product, energy, and you also have this REC. It's convenient, and developers like Tom want to get value from that byproduct. But if the demand for the product is so low that you really can't even just make it worth your while to trade the thing, then it's not going to do anything. They'll just essentially be kind of discarded and won't have any effect. The conditions for that to happen just don't exist in any sort of meaningful scale. I've written this before. You might be able to identify some exceptions, but there's never been evidence that that is the rule rather than the exception. And just to kind of end with this, it seems intuitive. Oh, low prices are low impact, and this idea of correlation. And you don't see that in any other space other than this conversation. And I always kind of point out to different products, like just because some wine is cheaper than other wine doesn't mean that the cheap wine producers care less about being paid. And by extension, you don't see uh, producers of certain products flooding into the higher price market. If the rec price being higher is inducing more development, then why wouldn't we have all developers flooding into the Washington, D.C. solar market where recs are $400? The reason is that rec prices are an output, not an input. It's a market signal. It's telling us something about market conditions. It's not something that we can manipulate and artificially increase to raise an impact. Again, I'm going to stop there, but an entire iceberg of other theories and stuff behind that, but I'll pass it back to Todd.
So,
Thanks, Eric. Go
sorry,
ahead.
before
Yeah.
let me just interrupt you, Tom. Before that one thing sprung to mind in something I've seen in in the literature is this idea of sort of transaction costs. There's transaction costs associated with these things, and so the this idea that the prices are, not zero, but that maybe the revenue that you get, their prices are so low that the revenue is only there to cover the transaction costs. Did you ask folks about that and sort of what did you find about related to, RECs and transaction costs?
Yes, that's something that we specifically cover in the white paper. Uh, Developers I've spoken to always put transaction costs in the range of 5 to 15%. So every single product has transaction costs. This is nothing unique to RECs. But if you think about something like 10% of a REC is in brokers and traders, something like that, which is akin to other markets. So if a REC is trading at $2, maybe 20 cents, maybe gets lost in the middle. It's just not a material chunk of. And this transaction cost assumption is at the base of a lot of these arguments. It's really surprising. It's a Jenga piece right at the bottom, and if you pull it out, a lot of stuff falls on top. Uh, but it's never been ever empirically demonstrated that RECs ever traded at transaction costs. Again, plausible exceptions. I'm sure that someone could point out to me geographies and times where that is the case, but it would be an exception, not a rule.
All right. And Tom, again, from your company's perspective, how should we think about REC prices in the context of project finance? Up until recently, national wind REC prices were trading around $1. Do $1 RECs matter?
Well, I think a dollar a rec is better than zero per rec, right? And I don't mean to sound flippant, but I mean any non-zero price. I think Eric touched on an important point, which is, if there were, and those of you with any training in economics know there's a difference between an average cost and a marginal cost, right? So, do we look at the entire costs of having a team of people who are marketing and transacting RECs for our company? And do we allocate sort of the average cost of that team among each REC? No, we don't do that, right? We have a team of people and the resources that they require to do their jobs, and we pay them their salaries, and we cover their cost, their office space, and their computers and equipment. And so effectively, the incremental cost associated with the work that they do is near zero. I'm actually surprised, Eric, that the number you threw out was as high as it was, because I think that's the way, I know that's the way we look at it internally, those costs are really not a factor in our deciding what to do. Now, could we make a business out of selling nothing but $1 RECs? Of course not, right? I shouldn't say of course not, but most likely not. But to your last question, Todd, I think a key point for us is, you know, I sort of threw out, a couple of us have thrown out sort of a definition of a REC, but Todd, you hinted at this. I mean, it's much more complex and nuanced than that. Eric, you touched on this too. And in our case, speaking just for EDP's business, we basically sell to two big categories of customers. One is utilities, most of whom are using RECs to meet their obligations, right, in states with RPS targets. And that was, even 10 years ago, maybe 15 years ago, but certainly in that time frame, that was essentially 100% of our market. Our off-takers, as we call them, our customers, the people who buy our energy from the renewable energy facilities that we own and operate, were almost exclusively electric utilities, and mostly for compliance purposes. What's changed really radically in the last decade or so is the rise of the voluntary market, and more specifically, because it's a much bigger, it's a dramatic transition, is the rise of global corporations and U.S. corporations who take it upon themselves. Sometimes there's governmental pressure or other forms of peer pressure. Sometimes it's entirely on their own volition, and we should credit them for taking steps to reduce their carbon footprint. But fundamentally, what we're talking about is that companies decide to take on the task of reducing their carbon footprint, and one of the ways that they do that is by participating voluntarily, buying RECs to offset their own energy usage. And that market has grown very, very rapidly, to the point where I probably shouldn't give you an exact figure, because it is a company sensitive confidential information. But I will say that it's a very substantial minority of the REC sales for EDP is to corporate buyers in the voluntary market. Okay, and so that's just a sort of a binary segmentation, meaning compliance REC buyers that are buying for compliance purposes, and buyers that are buying for voluntary carbon reduction goals. But there's also many more nuances beyond that, and I'll give an example of some of those things. Sorry, my phone decided to buzz, which is a little distracting for me. So, there are different geographies with substantially different pricing. Why? Sometimes that's driven by compliance markets. Sometimes, meaning in some geographic markets, there's, renewable energy supplies are less abundant, or to put it differently, more scarce. And you don't have to have studied too much economics to know if in a supply-demand equation, if there's lower supply, then you're going to see a higher price, right? So that's one further segmentation. But even in the voluntary markets, there are factors that drive different prices, partly across different geographies, partly because companies have preferences in terms of the technologies that the RECs are derived from, partly because companies have other preferences in with respect to what RECs are purchasing. Most of our RECs, by the way, going back to the pricing issue, are sold on a bundled basis to both are those two big buckets of customers that I alluded to earlier, which are the utility customers and then the corporate buyers. Both are most often, again, I won't give you an exact percentage, but let's just use a ballpark figure and say it's around 80% of our energy and RECs goes in the form of bundled sales to those two categories of customers. And the reason that's important, and Eric may want to speak to this, or Todd, you can ask a follow-up question if you're interested. But the reason that I think that's important is because you're essentially talking about ghost pricing of the REC in that situation, right? The price for the energy and the price for the REC are bundled together in that transaction. And I have nowhere near the sophistication that Eric does in terms of how he studied this. But my thought is that if in the literature most of the REC pricing is associated with pricing for unbundled RECs, then that could very well be a very different market environment. And then and it's hard to extract the price of the REC when it's bundled. But I'm guessing that disproportionately, the RECs that are bundled to those two major categories of customers in our case are higher priced than the voluntary unbundled RECs that are, especially merchant RECs that are also available out there on the market.
Okay, so let's get into that. So we said Rex matter, low priced Rex still matter, but as you point out, Tom, real differences, or rec classifications or market distinctions, right? Such as regional differences, buyer type, deal structure that are meaningful to developers that may correlate with higher versus lower average prices. So a lot of this debate, so I want to dig down deeper into those distinctions and which distinctions matter because a lot of the debate has focused on bundled versus unbundled. And I want to ask whether sort of that is a meaningful distinction. Eric, in your work suggests that similarly, contract structure, revenue certainty matter, and may matter more than this bundled versus unbundled distinction. Can you explain that and give us, more information about that?
Yeah, so let's start with what matters. The contract structure absolutely matters. Uh, Project development hinges on having a stable future revenue stream. And we don't have time to get into the details of why that is. Basically, if I know I'm getting $1 5 years from now, that's worth a lot more to me than if I think I'm getting $1 5 years from now. So long-term rec contracts make a more material difference in the development of new projects for specific projects than do recs from the spot market. More continuous gradient of impact, not binary. So contract, absolutely. Bundled versus unbundled, I'm increasingly coming around to the position that that does not matter at all. And the simplest reason I think that would explain this is that no project has ever been built because someone promised to use their power. Project developers do, maybe Tom might put this different way, but project developers do not care who uses their power. They build projects to make money. If you have a long-term rec contract, does it matter if it's the same person that is also having the contract for the power? I can't see a reason why. So I have increasingly come around to this idea that the bundled versus unbundled, a lot of times I'm giving the benefit of the doubt for people who have made that distinction in the past. I think it was just shorthand, simplified for the sake of exposition. But I think it's time we should probably push folks to being a bit more precise about the terminology and do away with this idea that unbundled recs, there's something inherently wrong about them. You can have a long-term unbundled rec structure that is the exact same thing from a financial perspective as a long-term bundled rec contract. I just think that distinction is increasingly not helpful.
Okay, so maybe long-term versus short-term matters, maybe contracted from the perspective of the developer versus I don't know what we would say, merchant
Yeah.
arrangements matter more than bundled, unbundled. So I guess, Tom, I mean, I want to ask you generally sort of how different rec structures, long-term contracts, VPPA structures, merchant rec sales, affect financing and risk from developers' perspective generally. But, you know, I guess that begs the question then, what role does the voluntary merchant rec market play in development decisions? We've said low-priced recs still matter, and we've said maybe unbundled versus bundle is not a useful distinction. But then is there this category of recs, maybe this merchant rec category that doesn't matter as much, or short-term rec sales that don't matter as much to developers? How do you think about the different rec structures?
Mhm. So I'm gonna make two points, Todd. One is to riff on what Eric said because this popped into my head as he was talking about the unbundled and bundled distinction. And this is a complete hypothetical, but I think it's a useful one. I could envision, my company, EDP, having a corporate customer who operates within a compliance market, meaning in a state that has where the utility providers um, have compliance obligations with respect to RPS laws, right? But we might have a corporate buyer in that region who doesn't care about recs, right? Maybe they just want a long-term fixed price contract for energy delivered from our project, but they don't care one way or the other about the recs, right? So in that situation, we'd be pretty happy because that if that off taker, that customer, doesn't want the recs from that project and we're in a compliance market, then those recs are going to be pretty valuable to someone else who does have a compliance obligation in that region, right? So that's just one example of the nuances, and it's our job as professionals and business professionals to look for opportunities to capture the economic value associated with these. Again, as I've said at the outset, this sale of essentially two different co-produced commodities, right? The energy and the RECs, um, to create value. So that's my first point. The second point, Todd, to the question you asked about the voluntary merchant rec markets, um, you know, there's no question. I think that in general, and there's certainly going to be exceptions, that prices are lower in the voluntary markets because you don't remember that supply demand imbalance that I talked about earlier isn't necessarily there within the voluntary market. It depends on the sort of geographic scope that voluntary customer is interested in with respect to, you know, from what distance or from what region do they want those recs for their business facilities. And then, so voluntary recs and merchant recs, which means they're not contracted for. I think the voluntary recs are going to tend to be lower priced and the merchant recs tend to be lower priced, but there's still value, right? So again, any price above zero, um, as long as there are not significant transaction costs, and I said earlier that I think the transaction costs, depending on how you interpret them, but I think they're basically nil in this context, creates an economic opportunity for us. So in our case, I think the most common example where we end up with merchant recs, since I've already said that roughly 80% of our recs are sold under bundled energy and recs agreements to customers, compliance customers, and voluntary customers that prefer those bundled arrangements. But let's just say, those contract terms vary. To Eric's point about contracts being important here. So those contracts may be for, typically 15, 20, even 25 years, sometimes shorter, sometimes longer, but that's usually the time frame. And, we're getting to the point now where we've been around a while and we're starting to see some of those contracts roll off, right? So we may have a customer that wants to renew that agreement, both for the energy and the RECs, or we may have a customer that wants to renew just with respect to the energy or just with respect to the RECs. In that situation, assuming they don't want an extension of the bundled contract, then we have either energy for sale or RECs for sale or both. And again, that absolutely is a market opportunity we're going to pursue. And the value of that opportunity is going to be associated with a number of the factors that we've already discussed. Where do the RECs come from? Geographically speaking, what do the RECs come from? Technology speaking, and and what is the market like? Eric made a great point early on that it's a market. There are buyers and there are sellers, and we don't define what the price is. The market defines what the price is, and so we're always looking for opportunities to capture that value, and of course we're going to do the best we can to sell it at the highest price possible.
I'm just thinking about these new distinctions, or like or some of what we've said in terms of short term versus long term. Eric, I know that you've been thinking about that distinction more carefully as well as you look at trends in the voluntary market. And as the data that the Green E program puts out about voluntary certified voluntary sales, you know, Tom, you said that the majority of the RECs you sell are bundled, but if we look at the voluntary market overall, we're seeing the majority is unbundled REC sales. And so um, I wonder about the relationship between unbundled and bundled, or short-term versus long-term, or merchant RECs versus contracted. Are there longer-term contracts underlying a lot of or supporting a lot of the shorter term merchant REC sales? Are those two markets linked in more complex ways that are important to this discussion? Eric, maybe I'll ask you that question first.
Well, first, I would note that the voluntary market in the US is always shifting towards more long-term contracts, more quote unquote direct procurement, where buyers buying directly from a project. Um, and by extension, more bundled. Again, I'm agnostic whether that's a good thing, but the market's always shifting in that direction. Uh, in terms of the linkages, again, that's why the bundled, unbundled, spot market, some of these distinctions aren't really getting at what matters. What matters is revenue certainty. And on the spot market, there are long-term rec strips. You can say, well, I'll buy from this project for 5 years. The merchant market, what ultimately makes it less impactful for a specific new project. Again, I'm trying to make this distinction between this project level impacts and this kind of market level aggregate impact, is the fact that investors are going to be more skeptical. And that's where a lot of rubber meets the road, that you need lots of capital for big new projects. And if an investor says a merchant rec market, there's these banks, I'm less familiar with that, I'm a little skeptical, they're going to discount the value of that. But as Tom said, it's still money. It's still money going to projects. It's still money going to developers. It may not make or break a new project, but that money doesn't disappear into a void. It goes somewhere into this financial ecosystem of project development.
Yeah, I just wonder if some of the data that we're seeing in the market about the volume of unbundled RECs being sold, it actually sort of hides some of the connection between long-term contracting and merchant REC markets. I mean, maybe that's what you're talking about. But yeah, it seems like, just to sort of summarize what I heard, the REC classifications, market distinctions that are meaningful to developers, that correlate maybe on average with higher or lower prices. Um, it it still seems unlikely that any of those classifications are entirely irrelevant, or that developers would be sort of indifferent to their removal, and that the importance of those things shifts over time, and may sort of differ between short-term considerations and long-term project planning. Um, and so, and then in addition, the classifications that seem to matter most to developers are generally more nuanced than the broad categories of voluntary versus compliance, or bundled versus unbundled, or RECs above a certain price versus RECs below a certain price. Um, I want to ask about um, I want to sort of where I want to leave time for questions at the end here, and I want to get to your thoughts on the future and sort of looking ahead, how we might sort of improve our understanding what all of this means in terms of standard development and impact recognition and policy. But I did want to ask you, Eric, sort of about where kind of where we started by looking at the existing academic literature and the methods that they used, the evidence that's been provided. One thing I've heard when we talk about the work that you've done and the interviews with developers and investors and other market participants is that those methods are more qualitative. They're uh, uh, different than the methods that are used in this other research, which tends to look more, I guess, at traditional project level financial modeling, more quantitative data. So can you tell us a little bit more about, I guess, the methods that the academic research has approached this question using to date, and what kind of methods are typically used versus what methods you employed, what tact you chose, and whether there's a difference between the evidence that you provide and the evidence that they provide.
Yeah, so the vast majority of the evidence in the literature is based on financial modeling, which essentially means someone makes a series of informed assumptions, creates a model, and says this is the role of these different inputs to the output of a project. Uh, that can be really informative, especially if you're a big buyer that wants to know how your specific impact is in a project. But that is not the end all be all of the effects of any sort of input on project. Project level analysis, if depending how you define it, uh, can show that most anything is or is not impactful. Another approach is using these things called capacity expansion models. It's kind of a bigger technical thing to say, well, we have this model of the grid, and then you kind of change some inputs that go into it and then see what happens. That's more complicated and even more so difficult to find an impact. And just the issue with those sorts of models in general is the way you define the lens can determine the output. And it's very easy, in my view, to kind of move things here or there and say that something is or is not impactful. They're very informative. They're very, very informative models. And I talk a lot about how they can be useful. Um, the third ideal quantitative approach, most of what I do for the labs is econometric work, meaning take empirical data, observe data, and then make some inferences about cause and effect. Uh, that's most of what I do. And I would love to do that for this market. And I just do not think it is viable. There's lots of statistical challenges that make it very difficult. In my professional opinion, the very few studies that have tried it have not done it successfully. They have not addressed those challenges. That's what led me to think, well, why shouldn't we go directly to developers and get their view? They are the ones that are making the decisions. I want to know, how do they view Rex, and what do these models get right and what do the models get wrong? Compile information on that, and let's save time for Q&A, but the white page or the white paper goes into some of the details about the way that developer views diverge from research, the way they converge in research, and some suggestions for maybe we could use the way that developers like Tom see the world to better inform future research.
That's helpful. Tom, I don't know if you had anything to add to that.
Yeah, if I may,
Yeah.
Todd, and I'll be quick. I think, and I'm picking up on thoughts from the last few minutes. So I think one key point, I did not mean to suggest that EDPs that I mentioned that EDP roughly 80% of our rec sales are in bundled energy rec transactions or contracts, long-term contracts. I did not mean to suggest that that's necessarily the norm across the industry. I think that we're a pretty big player in this arena, and our customers are pretty big players, right? We sell to, again, major utilities, mostly investor-owned utilities, and to very large corporate customers. The sort of almost cliche is the big tech folks, the data center owners and hyperscalers and so on, who I think feel maybe more of an obligation than your typical corporate player to mitigate the impacts of their carbon footprints. Um, but but we have plenty of other large corporate customers as well. So I think we and they both prefer to transact in sort of bigger chunks. And so I think that is at least partly an explanation for why our number unbundled versus unbundled is so high. But so that's one point. And then the other point I want to make is, I'm glad we touched, even if only briefly, on the financial models because, we do have another customer out there. And, we don't self finance all of our projects. So we end up with a financial investor who's also essentially a partner or customer for that project, not a customer in the sense of being an off taker for the energy and RECs, but essentially a bank that's helping us make the investment in these facilities long term. And and they like, to a point Eric made right at the beginning, they like certainty, right? So they're going to, not surprisingly, um, look at an agreement that has a 20-year contracted stream of payments associated with the RECs, and then look at another agreement that doesn't have a 20-year contract for the RECs, and they're going to favor the first over the second. That's almost inherently true, I think. The only reason it wouldn't be true is if the REC market were really volatile, like the price of gold or something, and people wanted to sort of hedge on the value of those RECs. I don't think we've seen a lot of that, if any of that, over time. So those are just two quick points I wanted to make before we turn to Q&A or to Eric
Yeah,
or
I mean,
comments.
I want to get to some of the questions, and I think the last question I'm going to ask gets at some of the questions that have been coming through. And thank you all for entering your questions here. A lot of questions about the proposed updates to the Scope 2 protocol, and interest in or increasing interest in hourly matching, in more local sourcing and local procurement, deliverability boundaries, those sorts of things. I want to sort of wrap those questions into, stepping back. We move beyond these sort of simplified narratives. How should we think about deployment impacts of voluntary rec markets? And then how might we understand or improve our understanding of how voluntary demand drives renewable energy, and what sort of market policy or standard changes would be best for renewable energy deployment? I know there's a few questions in there, but just looking for the future and thinking about a better understanding of rec market impact, how does that inform what type of market or policy or standard changes might be best to support renewable energy deployment? And maybe, Tom, maybe I'll start with you.
Yeah, I have. Thanks, Todd. I think one of the things I care most about is frankly, and this is self-serving because I have a long-standing relationship with CRS, but the role that CRS plays in sort of establishing and maintaining standards for REC sales. RECs are by their nature an ephemeral product. It's not a particularly tangible product. And there are lots of opportunities. The most obvious one is double counting, where if there were pervasive misuses of in that market, that it could really damage the credibility and viability of the markets that we're serving. So to me, I really, really respect the role that CRS and some others who work to maintain sort of the high road in this area, um, the work that they do, because I think it's really crucial to the long-term viability and sustainability of the markets that help drive, as we've said over and over again, a significant revenue contributor to the projects that we want to and ultimately get to build.
Yeah, and Eric, again, thinking about how we should actually think about the impact of voluntary rec markets in the future, and how that could potentially affect or inform market or policy changes. Um, what are your thoughts on that? And maybe if you could specifically speak to, the some of these proposals for smaller deliverability boundaries or hourly matching, that'd be helpful.
Yeah, so I think maybe this we've made clear that a lot of the puzzle around deployment impact has been solved. It's revenue certainty. Uh, how much, if you want to distinguish high impact from some impact, do you have a material role in providing certain revenues, long-term contracts? It matters who buys the power. Uh, it seems clear enough that we're moving into a world of stricter boundaries, deliverability, and hourly matching. And on that note, in terms of deployment impact, I would just note a lot of the arguments for deliverability and hourly matching are not related to impact on project development. They're almost a normative stance of, well, you should be using the power that you claim to be buying through your RECs. And a lot of that is going to be divorced from impact, the idea. Again, no developer in history has built a project because someone said that they would use the power. Developers build projects to make money. So that is what matters. But a much more compelling argument for hourly matching and deliverability is that it creates a stronger market signal. It creates a discipline that will force buyers to incur certain costs that they would not otherwise be willing to do under the certain status quo, the current status quo. Will that materialize? I don't know. That's a feasibility question. But that to me is a much stronger and more compelling argument about the potential impact benefits of deliverability and hourly matching. I am not yet persuaded that those effects would materialize.
Okay, I've left less time for audience Q&A than I had hoped. I apologize, and again, we will follow up with all of you who have submitted questions via email. But let's get to some of these before we wrap up. Maybe I'll start with this one. Did it come up in the interviews? Maybe this question is for you, Eric, that because RECs are a byproduct and have almost no production costs, um, anything they are sold for is essentially pure profit margin.
Yeah, this is a common one that Rex are like this windfall that you just get this Rex and every year developers, oh wow, we got this and they put it into some other treasure chest and then it disappears. Uh, that makes no sense again in a highly competitive, low margin industry. Uh, there's no binning. It's not like, well, the last dollar that came in, that goes somewhere else, and the rest of it that goes in new. No, it's revenue. It all is marginal revenue, and whether it's the first or the last dollar that comes in, it one way or another goes back into investing in new projects because it's just really, really competitive.
And then here, this is a question I think about sort of voluntary and compliance markets. It says, I've heard arguments that buying voluntary RECs retires the RECs, makes it unavailable for utilities that must buy RECs to meet statutory obligations, so keeps it out of the compliance market. The result is that utilities must buy other RECs, and that is a driver for new renewable energy development by the utilities. If voluntary purchases slow or stop, will that leave RECs in the market, which the utilities can then purchase instead of building new projects? So, do you have thoughts about that argument or the value that the voluntary markets provides basically by keeping RECs away from compliance entities? Maybe Tom, I don't know if you have any
Yeah, I
thoughts.
can
Yeah.
touch on that one. And that came in from Rob Harmon, who's a very good friend of mine. So, Rob, it's good to hear from you, even if just in writing. But as usual with Rob, I think he's making I think a very clever point and a very simple and clear point. So, yeah, I think my one word answer is that the retirement of RECs in the voluntary market does essentially, it's back to supply and demand. If you're stripping out part of the supply to serve the voluntary market, then the supply that remains is scarcer. It's a scarcer commodity, and would tend to increase the price for those RECs, or have other folks expand the available supply in order to meet the market.
All right, I think we have to wrap up here, and I want to thank you both and apologize to those of you who submitted questions that we weren't able to address, but we will follow up with you. And thank you for your questions. As we wrap up, I do want to remind you all that part two of this webinar series will be next Wednesday, April 8th at 2 p.m. Eastern. Um, Today's conversation is focused on sort of grounding this debate about the impact of REX in developer and investor experience. We've heard that, the story is more nuanced than the headline claims about low prices, and that contract structure and revenue certainty and market dynamics matter. I think in part two, we're going to continue the discussion with Eric and look at some of his other work, which uses economic principles and market data to re-examine assumptions about unbundled RECs specifically and voluntary demand. We really hope that you'll join us for that conversation. Again, next Wednesday at 2 p.m. Eastern. Thank you so much for joining us today, and thank you again to Eric and Tom for joining us. And have a great day. Thank you.
Thanks.